Are we truly on the brink of a US recession, or is the market telling us a different story? It's a question everyone seems to be asking. Big names like Goldman Sachs and jpmorgan have raised their recession probability forecasts. Goldman Sachs now puts the chance of a recession in the next year at 20%, up from 15% earlier. jpmorgan is even more worried, putting the odds at 1 in 3. But what's driving these predictions? These numbers are based on things like how the economy is doing, how many jobs are being created, and how much stuff costs. The economic dashboard. Think of the economy like a giant car. To figure out if it's running smoothly or heading for a breakdown, we need to check the dashboard. And in the economy, our dashboard is made up of key indicators. First up, we've got the jobs report. It tells us how many jobs were added or lost each month. A strong job market is a good sign. People are working, earning money, and spending it. But if jobs start disappearing, it could be a sign of trouble ahead. Next, there's inflation. A little inflation is normal, but if it gets too high, it can eat away at our savings and make it hard to afford everyday things. We also need to keep an eye on interest rates. These are the costs of borrowing money. When interest rates are low, businesses borrow more, invest more, and the economy tends to grow. But when the Federal Reserve raises rates to fight inflation, it can sometimes slow the economy down too much, leading to a recession. All these indicators are flashing some mixed signals right now, making it hard to get a clear picture of where we're headed. The stock market roller coaster. The stock market can feel like a roller coaster with its sudden ups and downs. One minute it's soaring to new heights, and the next it's plummeting faster than you can say bear market. But what's been causing all this volatility? A few things have been spooking investors. Remember that thing about interest rates? Those have been going up, making it more expensive for companies to borrow money and potentially impacting their profits. Then there's the whole unwinding of the yen carry trade situation. Sounds complicated? Basically, it means that a bunch of investors who borrowed money in Japan at super low interest rates to invest elsewhere are now having to sell their investments and pay back those loans, causing some chaos in the market. And let's not forget about Warren Buffett, the Oracle of Omaha himself. He's been selling off some of his Apple stock, which has some people wondering if he knows something we don't. Tech titans are shaking the market. Remember those magnificent 7 tech stocks we mentioned earlier? They're like the cool kids in the stock market cafeteria. Apple, Microsoft, Amazon, Google, Meta, Tesla, and nvidia. These companies have been on a tear in recent years, their stock prices skyrocketing as demand for their products and services exploded. But even the cool kids have been feeling the heat. Their stock prices have been swinging wildly, sometimes losing billions of dollars in value in a single day. These companies are facing some of the same challenges as the rest of the market, like rising interest rates and economic uncertainty, but there's also something else at play, the AI boom. Is AI hype fueling the tech stock roller coaster? AI is the buzzword on everyone's lips these days. Every company is trying to get in on the action, and investors are pouring money into anything remotely AI related. This frenzy has supercharged the stock prices of tech companies like nvidia, which makes the chips powering AI applications. But it's also created a bubble, with some experts warning that the valuations of these companies have become detached from reality. And when those bubbles burst, as they inevitably do, things can get messy. That's why even a minor earnings miss or a whiff of bad news can send tech stocks tumbling, taking the rest of the market down with them. Market jitters versus recession reality. So the stock market is volatile and tech stocks are particularly jumpy. But does that mean a recession is inevitable? Not necessarily. The stock market is not the economy. Just because the stock market is freaking out doesn't mean the economy is on the verge of collapse. There are plenty of other factors to consider, like consumer spending, business investment, and government policy. Economics crystal ball or magic 8-ball. Economists love to make predictions, but honestly, predicting the future is hard, especially when it comes to the economy. It's more like shaking a magic 8-ball than peering into a crystal ball. There are so many variables, so many moving parts, that it's impossible to predict with 100% certainty whether a recession is on the horizon. Even the experts get it wrong sometimes. Remember the Great Recession? Not a lot of people saw that one coming, while those recession probabilities from Goldman Sachs and jpmorgan might seem scary. It's important to remember that they're just that, probabilities. They're not guarantees. The Buffett Indicator. One of the most closely watched economic indicators is something called the Buffett Indicator. Why Buffett? Because he's Warren freaking Buffett, that's why. This indicator compares the total value of the stock market to the size of the economy, as measured by the gross domestic product, or GDP. The idea is that if the stock market is way bigger than the economy, it might be a sign that stocks are overvalued and due for a correction. Right now, the Buffett Indicator is flashing yellow, meaning it's elevated but not quite in the red zone yet. It's something to keep an eye on, but it's not a reason to panic just yet. What about the yield curve sign? Another indicator that economists obsess over is the yield curve, which is a graph that shows the interest rates on government bonds of different maturities. Normally, the yield curve slopes upwards, meaning that investors expect to get paid more for lending their money for longer periods. But sometimes the yield curve inverts, meaning short-term interest rates are higher than long-term rates. And historically, an inverted yield curve has been a pretty reliable predictor of recessions. Is the yield curve inverted right now? Yes, it is, which has some people worried. But it's important to note that the yield curve is not a perfect predictor. It can sometimes give false signals, and it can take a while for a recession to hit after the yield curve inverts. Are we headed for a recession? After all that, you're probably wondering. The honest answer is, nobody knows for sure. The economy is sending mixed signals, the stock market is volatile, and even the experts are divided. There are certainly some reasons to be concerned, but there are also reasons to be optimistic. The best thing you can do is stay informed, avoid making rash decisions based on fear or hype, and remember that the economy goes through cycles. If you found this analysis insightful, be sure to like and subscribe for more in-depth explorations of the fintech market trends and economic developments. Stay tuned and stay informed.